Because one of the things a lot of investors don't do is go back and be honest about where they got fucking lucky and where they had a thesis that they could potentially replicate in future investments.
Superclusters is the podcast that demystifies the secrets, stories, and tactics behind the money that moves the venture capital world. To Superclusters fans, welcome to the postseason, where a few friends and I take a few liberties that depart from the format that you've gotten used to. Our purpose is simple: to decrease the opacity behind conversations LPs have, and sometimes it is easier to peel back the curtain with concrete examples and willing volunteers. Before we get into the thick of it, I want to thank Jeff and Martin for your time, your courage, and your willingness to be transparent. It's not easy, but I, along with all our viewers and listeners, deeply appreciate you. So I'll share a little bit of introduction for our two guests today, and we'll dive deeper into it as Jeff and Martin will share a little bit more about their past as well. So Jeff Rinvelt is a partner at Renaissance Venture Capital, a firm that boasts a portfolio including the likes of Techstars, Greycroft, 5AM Ventures, Sierra, and more. Prior to Renaissance, Jeff was a director at Ardesta and helped scale the team from 5 to over 60. In a previous lifetime, Jeff was both founder as well as consultant, the former as the co-founder of Grapevine Technologies, which caught the eye and eventually led to the acquisition by Sun Microsystems, and the latter at Ernst & Young. He is the chair of the Michigan Venture Capital Association, as well as the advisory council member for the Michigan Founders Fund, just to name a few. At Renaissance, he boasts a portfolio of 60 investments, with about 27, 28 being fund managers. And then we have another gentleman, Martin, who I've gotten to know pretty well over the years and all that. Martin is the founding partner at Incisive Ventures. And I want to preface for all our listeners that Martin is not your typical emerging manager. Although Incisive Ventures does fall into that bucket. Engineer by background, Martin found his way into the world of venture as a founder, exec, having run 3 venture-backed companies and going through 2 IPOs, as well as raising over $500 million for those companies, while moonlighting as an angel and an LP since before the great financial crisis. Having invested into great companies like Google, DocuSign, OpenSea, a lot of companies that our viewers and our listeners are familiar with, and has since invested, and correct me if I'm wrong here, over 200 companies as an angel. He founded Incisive Ventures, a pre-seed venture fund focused on technology companies that reduce friction at scale. Outside of the world of investing, Martin's an avid mountain biker, and correct me if I'm wrong here, a proud owner of a 29er full suspension bike, and a surfer as well.
Just rode it today.
Amazing. Okay. We should have caught all of us riding bikes or something, because I know we're all across different geographies over here. Martin, you're in the upper Northwest. Jeff, you're all the way in the East Coast, or not East Coast, but like, what's that?
Midwest.
Okay. I'm forgetting. It's west, but it's like, so it's east of me and Martin. And I'm out here in the Bay Area. So I'm glad the both of you can be here. The two esteemed gentlemen on the other side of this virtual table. So Martin, Jeff, welcome to the show.
Thanks for
having us.
Well, amazing. So as a general compass for today's journey, both for us, but as well as for our viewers and listeners, we'll start with a little depth behind how, Jeff, you became an LP at Renaissance, and Martin, how you decided to start Incisive. But before we fly below the hard deck to catch the grooves of the terrain that led to why Jeff passed on Martin, it's Fund 1. We may veer port and starboard, but for now, that's the general heading. So to start things off, we'll start with you, Jeff. Why did you choose to be an LP back, if I remember correctly, 2008 for Renaissance? And what was the pitch you were giving to your LPs, large Michigan corporations investing out of their balance sheet?
Yeah, it was a very unique vehicle at the time, Renaissance, and that was the sort of the innovation that we brought to the fund of funds market at the time. If you think back, back then there hasn't been a lot of venture capital fund of funds. It was largely a vehicle that had sort of made its time and then disappeared. But what we brought to it was there was a large corporate base in Michigan that wanted to have access to the innovation economy, but didn't want to invest in funds or couldn't do corporate venture capital funds themselves. So we said, okay, you guys you guys want to help out Michigan. You also want to help out yourself by being, access to these innovation economy. And so we sort of, connected those two groups, the other group being the venture capital community that wants access to those large industrials for first customers, for buyers. And so we did, the first pitch was largely just all the corporations, and much more was sort of, hey, we need to help Michigan. This is a great way to do it. But in the back of our mind, we were saying this is a great way to get to access to great funds. And now with sort of going after our fifth fund now, we've sort of proven that out. So we still keep those large corporations as sort of the secret sauce of Renaissance, and that side. But we still have large the normal LPs are our LPs now, basically, side of it. So the pitch was more, it's like you can help out Michigan, help out your corporation, and make money at the same time. And we've sort of proven that out. We also now have sister funds around the country that I got to give a shout out to. There's Centrifuge in Cincinnati, Houston Exponential in Houston, and there's also one called Nothing Ventured, Nothing Gained in Wisconsin.
That is a great name.
It is. I wish I'm a bad neighbor. They're a much better neighbor than I am.
I love it.
I should have chatted with them before I named the podcast.
I know.
I didn't know about these things. Well, I appreciate the additional context. But for you, when it came to like jumping this world, as I mentioned earlier, you were both a founder as well as a consultant in your previous life. Why did you pivot to the world of investing in venture funds?
So my career is all a bit about diversification, so I did a startup founder, one company, multiple one companies. I then did actually do a direct investment. Ardesta is actually a fund. So I did direct investing that had tens of companies. I saw the things that, large, governments and fund of funds were doing sort of wrong by trying to attract venture capital to their communities. A lot of times they weren't attracting the best venture capital firms because they were doing hard side letters where they sort of said you had to commit so much capital to a certain region, or you had to do all these other hoops that basically you had to get the money. The best venture capital funds are never going to do that. So, along with the corporations, I also says, we believe there's enough going on in Michigan or we can connect you with the best things basically in Michigan. So we're not going to play defense. We're going to play offense and say, hey, we're going to invest in the best venture capital firms, run them up against the best companies in Michigan. And if you find a match, that's great, but we want you to make the best investments. And that way we can get to the best firms and we can have the best outcomes for Michigan.
That makes a lot of sense. And particularly, I want to ask about like how you think about portfolio construction, but also when you go out and hunt for these like venture capital firms, like how do you go around sourcing them? So I'll start with the first question about portfolio construction. From what I know, and once again, set the record straight if I'm wrong here, you can only trust so much on the interwebs. You are 40% IT, 20% healthcare, and then 40% emerging technologies, which include like agriculture, deep tech, green tech, and all these other things. How did you come up with that model, that allocation model?
It's a little, that's about right. But basically we sort of, look at the world as sort of 40% IT, 40% healthcare. And again, those are the two big buckets that have driven.
I was completely off. You were too nice. I was
No,
completely
you were, again, you look at PitchBook, everybody sort of does it differently, and again, our models are different than everybody else. So don't feel bad at all. But, our portfolio construction is, again, the two big buckets that have sort of driven venture capital since, since the beginning of time. It's IT and it's healthcare. So we usually keep those two as the two big buckets, and then again we're rolling up, so we can invest in firms that will do SaaS, that will do prop tech, will do all these other things. Sometimes they roll up into those big buckets basically for us. The emerging markets that we talk about is the extra 20% are things that we like and that Michigan's sort of good at, but we haven't really seen a lot of conviction. They haven't, popped in and out. So agriculture has been a great thing in there. Advanced materials has sort of been the other bucket, but there's been a lot of other things. I mean, if you want to do, clean tech as a whole bucket, deep tech is sort of another ones that sort of can be in there that have been bubbling around sort of an extra 20%. The other layer that we like to look at is, again, that early and late. Early for us is seed, Series A, and we'll talk a little bit about that with Martin, but there is sort of a growth venture capital market, again, that butts up against private equity. We're high conviction, high ownership, that most of our GPs are, and we could talk about Martin about that and different philosophies, but we usually invest in those early stages because they'll follow on and become later stages. So it's about 80-70% early, and then there's the extra 20-30% are sort of late. If I had to say, the next funds I'm sort of investing, the funds before I was tipping much more sort of towards pharma and healthcare. Now I'm probably tipping more towards IT. And again, these are small percentages changes. And if I had to say, I'm actually tipping more towards early stage and less towards late stage, sort of in the current, the way I'm investing now.
Gotcha. I want to dig into the gray matter behind Jeff Rinvelt's mind. When you mention that these are small percentage changes, how do you come to that conclusion? Is it through a conversation you have with your partners, or is it just something you're seeing in the market? You're seeing, hey, there are a lot more IT companies coming out these days. The multiples are a lot better. There's growth there. How do you shift percentage, like these small percentages?
Again, it was when we started off in 2008, you could sort of see the bubbling up of us, particularly pharma, that hadn't had any investment for a very long time. But you sort of saw a big gathering of the storm of where large corporations were going to need that capital. Right now, I sort of see that, that there's been so much money after the pandemic sort of has grown into there, and you start to see the IPO market start to go away. So you start to see, changes there. Again, with AI, I think IT is sort of at a forefront where it was the internet before, where you can start to see these large changes happening in a systemic change that I've been excited about since I actually saw the internet. So, I'm more excited that side. And again, this is much more with all of our teams sort of at Renaissance and our LPA, our LPAC, and also talking to great GPs like Martin and saying, okay, what are you seeing? What would you see? And starting synthesizing that and saying very small changes, over a long period of time, in our longer fund. So again, it's a sort of, again, just like Martin has a thesis, I have a thesis, and it's sort of bubbling up through all those great people and all the people we talk to.
That makes sense. I think that sets the stage a lot for what will come later in the conversation as we get more into reasons and all these other things. And one last question before we switch gears over to Martin over here. I've realized in doing homework for this conversation that, Jeff, you have a prolific past, present, and possibly most likely future when it comes to the nonprofit space as well, right? You are involved in the Michigan Founders Fund, you're involved in the Michigan Venture Capital Association, as well as someone, and I dug into the archives here, and I believe this was back in 2011, there was this kind of press article about this, where you've taught your children to allocate their allowances into 3 buckets, which is 1, spend, 2, saving for the college fund. And I think your children are at an age where they're like pursuing this college already. And thirdly, which I find to be really fascinating, which I believe you've called it make the world a better place kind of allocation. And my question there is, given all this nonprofit past and all that, how much of kind of like being an LP today is motivated by some of your past when it comes to paying it forward, giving back, and helping the ecosystem?
Well, first, you did your homework. And secondly, both my kids are now old enough that they'd be very embarrassed about that comment. So I just have to comment on that. And I also have to comment and give my significant other, that was my wife's idea. So that's, I take no, side of that. But both my wife and I have found, not-profit boards and just giving back a great way to motivate ourselves, but also, it's one of those flywheels where it's a double bottom line, triple bottom line, where you're expanding your resources, you're expanding your network, you're helping other people. It gives you a reason to get up in the morning. And it was one of those things that, like, my parents didn't do a lot of this, but was that I sort of found out through my career. So I would encourage everybody to sort of, as you go up with your career, sort of think about, nonprofit boards and giving back, allow you to try out different roles that you may not have and allow you to try different things, interact with different people. Usually the people you interact with on these boards and talk to are very intelligent, very, interesting people in different areas than you. And I found also a great intersection between startups and startup of nonprofits, where they could go through the same pain points. They have the same issues with cash. They have the same issue with the audits, all these other things. And that was some of the interesting between Michigan Founders Fund is saying there's a great mashup between startups and not-for-profits. They're all doing sort of the same thing. So, both sides can learn from each other. So, anybody, if I can take anybody from this and anybody listen to it, it's like, please, do not-for-profits. You're going to give back to your community. You're going to be a better person. Your community is going to be a better person. There's just so many great bottom lines from that. So I can't say enough great things about it.
I love it. I love it. And before we move chronologically forward to the day that you and Martin left, I want to go chronologically backwards in time, and we talk a little about Martin's background. So Martin, you and I have known each other for a bit, but I like one of the pleasures of doing this podcast is I get to do homework into some of my favorite people, which sometimes you take for granted. But I want to go back in time to how you came to this ecosystem, right? As an investor, for you, I mean, I mentioned earlier in the introduction, right? You were a founder, venture-backed founder, raised $500 million.
Yep.
How did you find your way to be an investor in the ecosystem, both as an angel and eventually as an LP as well? And then I'll follow up with the second part question, but I want to seed it in your mind. But one of the things that I find absolutely fascinating is really kind of your lens. Part of your deployment and fund strategy involves you being an LP in 17 funds.
Yes.
And so I'm actually really fascinated about that approach as well. So let's start backwards. And how did you find yourself to be an investor?
Okay. Thanks. And so, yeah, I got started as an investor basically because I got lucky. I was at Anderson Consulting, and I was working at Microsoft as a consultant. And Microsoft did the math and figured they could hire me cheaper than they could pay Anderson. So they hired me, and I agreed. And unfortunately, I waited for a year. I got an offer, and I waited for a year to take that offer. That year cost me $20 million in Microsoft stock options. I like doing the back testing of decisions sometimes, and sometimes it's not so good. But I went to work for Microsoft before the IPO. And I sort of had read about Microsoft, raising money from venture capital and the story and all of that. And my job at Microsoft was I was working in a group called Channel Policies, and we were doing the beginnings of electronic software distribution. So we were trying to figure out how to distribute software electronically without packaging in the enterprise. And that led us to working with a lot of companies that were doing digital rights management and electronic licensing, so innovation. So these were all venture funded companies. So I was working at Microsoft with those venture funded companies. And one of the things that I met Steve Krause, who was at US Venture Partners a long time ago. I found that these startups were having a lot of fun, maybe even more fun than me working at Microsoft at this big company. And so as I met these companies and work with them, some of them said they were raising money. And I said, well, maybe I could be an investor with them. So I made my first investments when I was at Microsoft, working with some of these startups. And, I invested in them and then gave them a contract with Microsoft, which improved the valuation of the company. And I'm like, hey, this is kind of a great flywheel here. If I can add value to investments, I can improve the odds that investment's going to be successful. And I made a few direct investments. And then very soon thereafter, I met this guy named Ron Conway, who was walking around Silicon Valley in the 90s with a shotgun, investing in everything that he could. And he ended up investing in these two guys named Larry and Sergey. And I was an investor in his first two venture funds. And those two venture funds, I don't know the exact numbers. Jeff, you might know them, but they're probably some of the best performing venture funds of all time. Because he was going around doing these small early investments in everything that came out of Stanford and all of these things. And he was in the first round of Google and all these other things. And basically, they issued IPO shares in Google to the LPs of that fund at the IPO, some of which I still own. And so my cost basis on Google is approximately 50 cents on those shares. And that's been a lifetime lesson to me of the power of getting in early to some of these potentially transformative companies. Now, you can either get in by investing directly or by being an LP. And so I understood the power of both of those models and have done both of those for quite some time.
Well, I don't think most people in the world can boast getting in on Google at 50 cents. I clearly have. I can't. In fact, I was a mere infant to date myself at the time. I know I'm Asian. I will not grow enough whiskers on my beard until ever. And I'll look like this until I hit 60. But you've clearly, Martin, you've been around the block for a bit.
Yeah.
And I'm curious, you've done phenomenally well as an angel investor, phenomenally well as an LP, obviously in like Ron's fund and a bunch of other funds as well. I'm actually really curious, why start a fund now? In 2020, if I remember correctly, that's the inception date of Incisive Ventures.
Yeah.
Why start a fund? Why not continue doing what you've done all this time?
So that's a good question. And let me also get back. When I answer it, I'll answer why I have a fund of funds that drives my own venture business. So basically, when the pandemic happened, I was running a company for a friend of mine, Dave Asprey, in Los Angeles called Upgrade Labs. It was a biohacking facility. We got shut down by the pandemic, and we recapitalized the company. It's doing fine. But I had some time on my hands, and I said, well, what am I going to do in the middle of a pandemic? The company I was just running got shut down. We have no idea when it's going to start again. I don't know what kind of company I would start. So I did what a good nerd does, is I started to do some analysis. And I said, where have I really had fun making money? Where have I added value? I've been a CEO of companies. I've been an investor as an LP. I've been a direct investor. I've done all these things. And I went through and I looked at all the LP investments I'd ever made, all the direct investments that I'd ever made, and the money that I'd made as a CEO. And I very quickly decided to not be a CEO again, because that was an 80-hour-a-week job, and I didn't want an 80-hour-a-week job. I also didn't know what kind of company I would start in the middle of a pandemic where you couldn't get any capital for anything and nobody knew which way was up. So I said, well, let's look at the two investing buckets, LP and direct. And basically, if I looked at at that time I was in 12 funds, I was doing approximately 2.6x on my total LP investments, which is above average or about average. I don't know, Jeff, you can tell me. It's a pretty good return for a portfolio of venture funds. But my direct investments, which at the time were about 200, were basically at 6.8x. And so I was 3 times better as a direct investor than as an LP. So I thought to myself, I'm not very smart, but I can do that kind of math. I said, well, maybe I should do more direct investing. And then the second thing that I did is I said, well, what kind of investing should I do? And when I had invested direct in the past, created the most outsized returns? Where did I get lucky? Did I have a thesis that I think I can replicate in future investments? Because one of the things a lot of investors don't do is go back and be honest about where they got fucking lucky and where they had a thesis that they could potentially replicate in future investments. If I was thinking about making more future investments, what I was looking for was this thesis that I could potentially replicate on future investments. So I went through all my prior investments. I took out all the cases where I got lucky. And I said, where did I have a thesis and what is that? And that came up with this idea of software companies that reduce friction at scale. So for example, I've made more than 100 times my money investing in a clean tech company, but I have no particular knowledge about clean tech. I got lucky. I made money in a material science company. I made money in a CPG company. I made money in a biotech company. But they were cases where I got lucky. I got somehow into a deal through a referral, but I didn't think my network had a good alignment with finding new opportunities like that. But because I came from Microsoft, because I ran software companies, took 2 of them public, and I had I knew about 300 GPs directly myself that were investing mostly in the IT side of things. I was like, maybe I can replicate this idea of software companies that reduce friction at scale. And the iconic company was, when I was at Ignition, we led the Series A of DocuSign. And that is, signing something on your phone instead of printing something out in faxing machine, millions of signatures a day. It became a platform. It was actually non-obvious because people thought in the beginning it could have been a feature instead of a platform. But when it was able to turn it into a platform and the leading brand, DocuSign made 100 times more for their investors than the number 2 person, EcoSign, in that category. So anyway, that led me to understanding the value of a platform and things like that. But so I said, here's a thesis. I think I can replicate it. I started making investments in 2000 with my own money. I have a personal $2 million a year allocation to write checks into early stage companies. It started going well. A bunch of my friends said, we'd like to invest with you. So I started a syndicate on AngelList because it was pretty simple to share deals that way. That quickly grew to 3,000 people. Then some of those LPs said, we want you to start a fund because we want to be in every deal we do. We don't want to have this deal by deal thing because we miss them and they oversubscribe and this and that. And at that time, I said, okay, maybe I'll consider it. When I was at Ignition, they offered me a position as a general partner. But at the time, being a general partner of a $300 million fund where CalPERS is your LP, I thought life was too short to have CalPERS as your LP. And also, you had to have a whole bunch of back office infrastructure at the time to be able to run a venture fund. Today, and in 2021 or two, you can basically get the back office from Carta and some of these other funds. So the idea of being a solo or even a two-person VC fund with the back office outsourced was possible today, whereas 5 or 10 years ago it was not possible. So I said, okay, I think that's a good idea. I started my first fund on AngelList, which was $2.5 million. And then my second fund now is $10 million. Which we are almost fully subscribed on, and it's off AngelList. But the reason I started a fund is that, well, the real reason I started a $10 million fund, and I'll be very quick to finish this, is so I invested for 3 years, my angel investing syndicate plus a small fund. That all went very well, but I was doing a varying check size between $10,000 and $400,000 because when you're doing angel investments or syndicate investments, your check size is more related to how much money you have in the bank or the appetite of the LPs at the time as opposed to any particular strategy. And that portfolio of 65 companies as of November, prior to November of last year, was marked at 2.8x TVPI and about 32% IRR. Now, some of those were bubble valuations, okay, but that was a decent return. But one of the things I did is I went and I back tested and I said, what if I had made a $250,000 standard investment across that same 65 selection criteria? What would that be? Well, it would be 8.2x TVPI and 112% IRR. So what that told me is that I should increase my standard check size to $250,000 across the same deal flow and selection criteria, and I would have a much higher IRR return for my LPs. And that's why I decided to raise a $10 million fund and write 30 $250,000 checks, because the math told me that my current selection criteria and deal flow, I would be able to make a higher IRR for my LPs. And it is a superior strategy in pre-seed to make a standard check size than to try to vary your check size, because you don't know which ones, our brain is not very good at picking which ones are going to end up being the unicorns and varying your allocation. So anyway, that's why I decided to start a $10 million fund, because the math told me that's what I should do.
Holy cow.
There you go.
First of all, that was a great high-level masterclass of how one should think about transitioning from being an angel investor to a general partner of a fund. The second part of which, and I want to circle back to something that I mentioned earlier, is you have been an LP and you've told me, I guess, offline, and we can edit this out if you don't want to include this, but you've told me that investing in 17 funds is part of your kind of fund strategy as well, because part of it is you've invested in some later stage funds and they end up becoming great pipelines for your companies that you're investing at the pre-seed stage to eventually rise into. And because you have those communications, you can call them up directly, like, hey, you know what, you should take this conversation.
So one of the things I had to figure out for myself as well is, what is my unique value add as a pre-seed investor? Why would a CEO who's raising $1.5 million take my $250,000 over somebody else's $250,000? Well, one of the reasons is that when CEOs are putting together a syndicate like that, they need to think about what they're getting from each investor. And some just care about the money, but my value add is follow-on financing. 74% of my pre-seed investments have received Series A financing, which is 2.5 times the average pre-seed investment if you look at PitchBook. And the reason is because I am an LP in 17 funds. I know 300 GPs. I have some proprietary software that I help my CEOs raise follow-on financing. And that is what they're getting from me, is this guy that's got a big network and can help them raise more financing. Hopefully, other people in that pre-seed will help them hire somebody or help them get business development or something else. The intelligent CEOs today are putting together a pre-seed syndicate of investors that have different kinds of things that are going to help them get to the next level. And my thing is follow-on financing. And part of the way I deliver that is being an LP in funds, but also having regular calls. I have monthly calls with some of the big multi-stage funds like NEA and Tiger and Co2 and these guys. And that's not something not a lot of pre-seed VCs do, but it gives me the ability to make these referrals happen faster for my companies. The other thing that being an LP in some of those funds does is give me the opportunity to lead the pre-seed when some of those companies get something that's too early. And I've done this. I have 6 investments in my current fund, and 2 of them were basically pre-packaged deals that were brought to me by a larger fund. So this company went to pitch Madrona. Madrona said, "We love the CEO. You're only raising $750,000. We can't fall out of bed for $750,000. So go talk to Martin." And I led the pre-seed. I put in 250. We got 2 other investors. We put a 750 round together. And then Madrona told us if they achieved this, that, and the other thing, they gave us 3 things. We want to lead the seed round. Well, the company a year later overachieved on those milestones. Madrona gave them a term sheet for $7.5 million raise, of which they would do $5 million. So the seed round happened with Madrona, but it was in some ways pre-packaged to me, and it ends up being a 2.5x markup from me. But Madrona is happy giving a markup because they got more traction done from a CEO that they liked ahead of time. They got the traction metrics they needed to be able to write the larger check to own 20% of this company, whereas they couldn't write the earlier check. So my being an LP in funds gives me that opportunity to be the pre-seed lead in some of these companies that might then qualify for these larger funds for a seed or an A round. And I think that's really an important thing that not a lot of pre-seed VCs think about. A lot of them are just thinking about tossing off checks. I think about who's going to mark up this deal and give it their next round. And if I have that person pre-packaged, it just improves the probability, which is why my follow-on rate is 2.5 times better than most pre-seed investors.
I love it. It's combining the data as well as all the kind of IRL qualitative metrics that supplement the numbers. Okay. This is the part where I do the cinematic whoosh, or at least Hollywood does it, but because I don't have a multi-million-dollar budget and a size of a team that's like 50 folks large for editing, this is the whoosh. Jeff, I've kept you in the timeout box for way too long. I want to fast forward to a period in time where Martin's deck for Incisive Ventures lands in your inbox or in your DMs. If you can remember from that time, can you talk me through what was really exciting about what you saw in that deck? What was really exciting about taking that first conversation with Martin?
Yeah, first off, we get a lot of decks. We get a lot of emails. I think I counted. This is sort of my talking with funds week, but I think I have like 10 different funds I'm talking to this week, and some of them are making up. Just sort of catching back with a fund or side of it. So again, it's not like being a GP when I was a GP where you get the the phone call volume, but it still is fairly robust. And again, for me, I try to take as many as those I can. I look back on my email and I did do okay on this one, but I try to be very honest with people. It's like, look at a deck or even, see their pitch and say, we're probably not going to invest for this fund, but I'm happy to take a meeting, and a lot of people just leave it at that and won't talk to me. Martin was nice enough actually to take the meeting, and hopefully that's, the better managers will take the meeting, because again, it's like, this is a long-term business. You never know when you're going to see people again. Timing matters a lot in this business. So it matters to get those meetings and understand a person, even if it's 10 or 15 minutes, to understand what was going on. What got me from the deck basically was it was short enough. I mean, it was 15 slides. It answered my questions. Most people usually drop off. I mean, you can tell just talking with Martin, he talks about allocation a lot, and that's very important. Most people going from angel investing to fund investing don't think about allocation. That's usually one of the biggest things we sort of see, first-time managers not do correctly. Sourcing. He's talked about sourcing. Again, that matters a lot. He talked about his thesis. He talked about his track record, and he got out in the slides basically and didn't overburden them with 15 other slides that I didn't want to know about, why venture investing was so great, all the other things that it's like, I'm an LP. I invest in venture. I should know those things. So that was the biggest thing that allowed me to say, hey, it's like, I'm probably not in for this fund, but, I would love to talk to you.
That makes sense. And flipping the script on Martin over here, was there a part of the deck or the pitch, your personal strength, so to speak, that you were most worried about not coming across in that pitch as you were, in that moment trying to relay that to Jeff?
Well, the biggest comment that I've had, and I was, worried about this with Jeff as well. There's two of them. One is some people could think of me as a generalist because I invest in software, but I invest in healthcare software, supply chain software, lots of different verticals. And I know certain LPs just simply don't like generalists. They would prefer to have specific people, like you're the crypto expert or you're the AI expert. I am not a general. I am not an expert in a specific vertical other than software. I am a little bit more of a software generalist. So I sometimes worry that, people just simply aren't looking for that. And then the second comment that I get a lot is, why the fuck are you running a fund? You're rich. And, it doesn't look like you need to do this. And I always like answering that question, but I get a lot of no's for that reason.
That makes a lot of sense.
I can comment on that, Martin, if you're okay with this, David.
Yeah.
I mean, my first thing reading your deck was, it's like, okay, and I hope it came through in a conversation, was like, okay, you definitely are a generalist. Generalists are definitely out inside in venture capital. I mean, we like people. We like to, again, as me as an LP, I want to put you in a bucket. I want to be able to say you're going to do, 100% IT, side of it. Again, because I sort of, prepped them already, so it's probably not for me. I was starting to say, it's okay, what's your fund 2? What's your fund 3 look like? And saying, where are you trying to get to? Your fund 1, you can be a generalist, and it might be somebody you can start to do an investment. You can start to build up maybe a team or people underneath you that help you side of it, and you can get more of a thesis. He does have a thesis on the, I would push back that you do have at least a thesis where it's like trying to wring out the, I don't know how to put it, but basically trying to wring out the friction basically inside, inside of it. So, but again, it isn't, again, that will probably hurt you as you go to more institutional LPs. But again, you don't have to have that all figured out for fund 1. So,
yeah.
And so in that kind of world where, Jeff, you're trying to bucket Martin into buckets and trying to understand, like, because you have an allocation model, you have LPs as well. This is the pitch you give to LPs. If fund managers don't fit in certain buckets, it just makes it hard for you to relay that story to your LPs as well. What does that exercise look like when someone comes to you who is more of a generalist, and they may touch a little bit of emerging technologies, they may touch a little bit of healthcare, they may touch a little bit of like IT, where they touch multiple buckets other than just that bucket you set aside for them?
Again, usually those are no's. I mean, just to be brutally honest, I mean, there's certain things that, because I'm investing other people's money, it would be fine for me, but because I'm investing other people's money and I'm trying to build a thesis, those are reasons that why funds will probably stay to a certain size, because they will probably never get into, institutional dollars. So again, it's not a bad thing. It's just sort of saying, it's like, where Martin's investing his own dollars, he can be much different when I'm investing other people's money. It's like, I have to stick to the script that they sort of have given me.
Yeah. And every so often you can improvise from that script, but you probably don't want to improvise too much, because then it just becomes an improv, or you're watching stand-up I mean, even stand-up comedy is largely scripted as well. So
Yeah, it is.
yeah.
But the other thing is that then I get called when I have to fundraise to my LPs. They were like, okay, well, why did you invest in fund X? And I'm like, okay, I gotta, it's either saying, okay, I messed up there, I learned from that, we're not going to do this again. I don't want to answer those questions the next time I'm fundraising. So again, I want to stick to my script because I got to fundraise the next time too.
And when you the script in which, like, just to analogize this, but the script in which you're pitching your LPs, whether you're a GP or you're a fund to funds pitching other LPs, is a great script because people are investing you because of that script. And if you deviate from that great script and trying to be more creative here and there, it's no longer the script they're investing into. They're gonna get a completely different product altogether. Now you've had the conversation clearly, like, Jeff, you love how Martin's thinking about allocation, about sourcing, and how he thinks about all the details. How far along in that conversation do you start realizing, hey, you know what, we've got to do our checks and balances here? And at what point, and we can probably like fast forward a little bit, at what point did you realize that Martin's Incisive Ventures was not a great fit for Renaissance?
I think it was pretty quick. I mean, I think it was even in the email. Again, these were get to know emails. I want to be, blunt. And I tried to, I did set up Martin, hopefully well, that he knew that this was a get to know you meeting. So, for me, it was like, okay, talk to me about fund one. Where are you going with fund two? The other thing that, again, we talked about, generalist VC. The other one that, again, there's two other things that as an LP that stood out for me, and are pluses and minuses for some LPs. For me, it was like, okay, I want to figure out where you're going with a fund two or fund thing. First of all, is the single GP. Sometimes that's amazing for LPs. Some people, we've never actually done it. I don't have a firm rule to saying I'm not going to. It's one of those things that would be different. And again, I have to get it through my investment community. I got to get my rest of my partners sort of, saying yes to that. So it would be something I'd have to get more comfortable with. The other one was more of a nuanced conversation, and has been things that we have conversations with all my friends, my other LP friends, about, was sort of the conversation around, are you buying a market of venture capital, or are you buying a high concentration, high ownership sort of GP? And, Martin was very upfront. Decided, said no reserves, which usually means somebody who's much more sort of for follow-on investing, or somebody who's much more sort of trying to do a market approach to it. I'm much more high concentration, high ownership. Again, there's lots of arguments why you should be market-based, but I don't do follow-on investments either. So I don't, I'm marketing that side of it. So those are two things I was sort of saying, okay, what if you had more money, what would you do? Or, with fund two, where are you trying to drive this market, trying to drive, fund two. So it was more trying to make sure they were aligned in how much I should watch them, basically, as Martin succeeds with fund one and comes out with fund two.
Martin, from your side of things, and this is where couples therapy comes in, right? Like this, I play the job of the steward. Was that something that you were used to getting communicated with? Was it in a format that was better or worse than other LPs that you'd talk to?
No, yes, I appreciate the upfront thing. I do the same thing, sometimes with founders. I'll be like, you're too early, or you're too late, or you're in a vertical I don't like. I'm happy to do a call with you anyway, because I think 6 months from now it may be interesting. I tell people right up front, and I appreciate that. I tell people in the first meeting if it's close enough or not, and I appreciate that when LPs do that. Many LPs don't do that. Many LPs will take a lot of meetings and blow you off and start diligence, and it's a complete waste of time. And I also knew that my product that I have, I get a lot of that. Like, it'd be great if you had two. I talked to an LP yesterday. He goes, we only invest in two GP, guys. And I'm like, you should have told me that 3 calls ago, because I'm not adding another GP. Yeah. So it would have saved everybody some time. But it's fine. I know that my product is not great for a lot of institutional LPs, because my product is really what I wanted and my friends wanted, which is a basket of pre-seed opportunities, first check only, no reserves, with the option of LPs to invest in the A alongside Tiger or NEA or one of those guys. It's really a deal flow thing, which is why I have sort of 5 GPs from other funds as LPs in my pre-seed fund, is that they're looking at it for the deal flow. So if you're not an LP looking for follow-on deal flow or co-investment, this is not the right product for you. If you're just simply looking for returns, or if you're looking for investing in a brand of a venture fund that is going to end up being a Sequoia or an NEA. I'm at the end of my career, not the beginning of my career. So I might have 1 or 2 more of these funds in, but I'm not going to be a $10 million fund, a $50 million fund, a $150 million fund. If you're looking for that kind of progression, I'm not the manager. I'm going to be maybe a 10, maybe a 20, maybe another 20, and then that's it. So I know it's not the right product for everybody, but like Jeff talks about, this is definitely the long game, and there are plenty of interesting people out there to meet, and I love meeting people. I love hearing people's perspectives, and I don't mind taking the meetings. Maybe there's something to do together. Maybe there's not. Maybe I understand. I mean, there was another fund of funds that passed on me, but I liked what they were doing. I met a family office that was interested in investing in fund of funds, and I introduced them. I mean, that's what you do in venture capital. You just keep making introductions to everybody that you can. And in the end, it comes around. So.
It does. It's about passing that good karma in the business. We are a relationship industry altogether, and the world is very small. Like, it is much smaller than we think it is. Everyone is at most a second-degree connection from anyone you'd possibly want to meet.
Yeah.
Both of you, I appreciate, Jeff, Martin, I appreciate the transparency. I want to round out this conversation, just be cognizant of time here. The large part of this podcast altogether is to really paint the humanity behind the investors that move the innovation world, right? Whether it's the LPs or the GPs. For the most part, in season 1, we've focused on the LP side of the conversation. And so, given that that's the thesis of the podcast, would love to ask you a question that I've asked like all my guests so far about in terms of the humanity behind it. And so a big question here, and I'll let you take a pick, but you can only answer one of them. All right. One is, I love this thing called an anti-resume. I have an anti-resume myself. Like, most resumes highlight all the good things that happen, and you go on LinkedIn, everything's perfect, right? I have one that highlights all my biggest failures, all my professional mistakes. So I'm curious, was there a time in either of your careers where you made a mistake or a bad professional decision in hindsight? And if you don't want to answer that question, the other question is, was there an investment opportunity you missed out on, not because of what you did, but because of what you didn't do? So I'll let you pick, but you can only answer one of them. Jeff, you want to go first?
Oh, there's so many mistakes. I love the anti-portfolio. I mean, I can't remember what VC firm has that, but has all the deals that they passed on.
Bessemer, right?
On Bessemer. There we go. I should know. Basically, Simon. Yeah, there's so many mistakes that I've made. I'll talk in more generalities again, but it's always been usually not firing people quick enough. It's around, basically not saying no quicker to things that you knew were never going to work, basic side of it. So, there's some, talking about not-for-profits, there's one, that I just got through basically where it was like, okay, knew it was going to work, just didn't pull the trigger quick enough, way back when. And that caused so much pain. And I have to keep doing those. The other thing is just hang around with people that are playing different games than you. We're all playing a certain, side of it. And I like to play, again, I use the word play wrong, but work should be play, and at least in my side of it. But I like to play long-term games with other people that are playing long-term games. If other people are playing short-term games, it's not really fun. So, what I always try to find out pretty quickly, we know Martin's playing a long-term game, we know you are. I like to hang around with those kind of people. And when people show me pretty quickly that are playing a short-term game, I really want to cut them off as quick as I can. So I know that's not, specific enough, but I need some, I need a little bit of cover because it just, my ego is too fragile.
I'm with you. I find a tough time, revealing names, concrete examples, because And part of the podcast is also for me to get comfortable with being vulnerable as well, in hopes of incentivizing and motivating others that they can do the same. Obviously, I'm younger in my career, so people say it's okay, you can make mistakes and all that. Okay, Martin, your turn.
The biggest mistake that I made as a CEO is one that I keep passing on to every portfolio founder, and I see people keep the desire of it just keeps happening over and over again, and that is the single concentration company making deal, first big deal of the company, concentration. So when I was running Imperium Renewables, we signed which was a biodiesel company, we signed a contract for $300 million take or pay biodiesel from a company called Hawaiian Electric. It was a company making deal. We pivoted and focused everything in the company about fulfilling that one customer. It actually was the backbone of our IPO and everything. Now, what happened is that we took our eye off the ball of the bigger market and the other customers, and it ended up that customer had some regulatory problems and the IPO didn't happen because of the window in 2008 and whatever. But because we were only focused on that, we were unable to get revenue from other customers because we concentrated on that one customer. And I see so many startups doing that. They're like, early they've got 5 customers, but one is responsible for 80-90% of their sales. And so they take and they focus their entire development resources on doing whatever custom features that one customer wants. And it turns out that many of those things are not replicatable in the rest of the market, or they're not building features that could be used by anybody except for that one customer. And so they end up getting pigeonholed, and there's a problem with that customer. This is a mistake I've seen CEOs make, especially early, over and over again. Concentrated customers and focusing too much on that first customer and not enough on building products and features that are applicable to a larger market that enable your growth, and you get stuck. This is a common problem for early stage CEOs. I've made it. I try to steer my portfolio companies away from it.
I love it. Such great insight. Martin, Jeff, it is such a pleasure to have both of you on. This is a fairly quicker, shorter duration episode, and thank you for being willing volunteers for this format. And if this does well, and our listeners and viewers can vote by way of liking, commenting, subscribing, following, tweeting, you name it kind of thing, we may do more of this format in the future. So Martin, Jeff, thank you.
Thank you.
Thanks for your time, David and Martin.
Hello, Superclusters fans. You've seen the logo at the beginning, and now we're here to address the elephant in the room. And the big question is, how intertwined is Superclusters and Alchemist Accelerator? And the truth is, Superclusters and Alchemist Accelerator are 2 completely separate entities, other than the fact that it is only I, David, your host, who is able to traverse between the multiverses. And so the reason Alchemist is a sponsor for Superclusters is the same reason why I ended up joining Alchemist. And it's for 2 reasons: the team and the product. So let me elaborate a little bit. For the team side, I was doing a bunch of diligence, homework, reference checks before I joined Alchemist. And I stumbled across a story which was between Ravi and an early team member of Alchemist. And for the sake of this story, I'm going to call that person John. So Ravi and John were working late at night because they had a deadline coming up. And as they were about to leave, Ravi found out that John didn't have a place to stay and had been sleeping out of his car the entire time. And the next thing Ravi did literally blew my mind, which was Ravi gave the keys to his place to John and said, "John, you're free to stay here for as long as you want." And I knew instantly that this is the team I wanted to join. This is the culture I wanted to be a part of. The second thing is the product itself. Alchemist has built this really robust product called the Vault, and it is the epitome of Peter Drucker's infamous line, which is, "You cannot manage what you don't measure." And so for the uninitiated, what is Alchemist Accelerator? Alchemist Accelerator is your startup accelerator for companies that monetize from enterprises. And so don't take it just from me. We've backed incredible companies, including names you've heard of: LaunchDarkly, Prevacera, MoEngage, And we're also backed by some incredible LPs and investors, including Coastal Ventures, Mayfield, Salesforce. And now, between you and I can't share any of the numbers. And if I do, our compliance officer, will literally gobble me up for breakfast, lunch, afternoon tea, and dinner. And personally, I'm too young to die. But I will say, the numbers, they're great. Like, they're really great. And so if you're curious and want to get involved in Alchemist and the ecosystem, check out alchemistaccelerator.com/superclusters. And that's superclusters with an S at the beginning and the S at the end. And we'll also include these links in the notes. Hey Superclusters fans, this is David from Post and want to share a few things before you go. If you're tuning in from the YouTube universe, and if you like this episode and if you want to see more of it, consider subscribing. It's free. Let us know down in the comments which LPs you'd want to see next or topics you liked and want to hear more of. If you're tuning in from the audio universe on Spotify, Apple Podcasts, or wherever content finds your ear, and you liked what you heard, give us a follow. And lastly, want to share a quick disclaimer from our legal friends. While I am the head of investor relations at Alchemist Accelerator, and that Alchemist Accelerator is one of our proud sponsors, the views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice, and any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor near you prior to making any investment decisions. And that's all from me. See you on the next.